Let's invite a market guest on the show, Anirudh Garg, partner fund manager at INVasset PMS, to discuss some of the market trends that we're observing in the run-up to the election verdict. Thank you very much, Anirudh, for joining in. First, just give us your sense of the market, how we are positioned in anticipation of the election verdict, and what's the best way now, if to make money. If someone has cash, what should they do?
Thank you for having me. I think we have to look at it from a broader point of view. The last 2 years, we have seen a tremendous rally happen in the mid caps, small caps, and especially the PSU and the capex sectors. These are the sectors that are leading the run, while we have seen that the larger heavyweights like private sector banks and information technology rather, underperforming. I think the trend should continue from here, but in an expensive market as we currently are, one should balance the portfolio well. So you need to buy both growth and quality, so that in case there comes a fall post-election or before election, I don't know when the fall will come, you are balanced. Your portfolio does not fall too much. And when it comes to growth, of course, the sectors that are leading the run, they have maximum relative change behind them. And that is the reason they should continue their, the run forward. So optimal combination of both.
So where is it that would you recommend booking profits, perhaps in stocks which have run up quite a bit, like defense, railways, or since that's been the government thrust, it's best to keep riding it?
See, it is not just about the government coming in that these stocks are rising. There is actual relative change happening behind them. Just see what is the government capex. We are at 11,000 crores, which is almost 5 times what it had been, 10 years before. So we have to focus on the fact that these are wonderful companies. These are the sectors that India needs. They are the sectors that are shooting out. Whenever, the sector that shoots out primarily, it starts looking expensive because of the relative change and the run that it has had. The price expansion has happened. The earning expansion is still to happen. So these are very good companies for the next 2 to 3 years, I suppose. So if somebody is holding them, I would recommend, not to sell them. They should be the leaders, according to us, for the next 2 years as well. While, just jumping into them when some euphoria, some extraordinary volatility or extraordinary interest is being created in the market may not be that prudent. So yes, add them on dips is what I would suggest rather than booking profits.
Okay, so stick to the theme. The theme is still working. Buy the dip. Got it, Anirudh. So that's your strategy. I believe you're also optimistic on real estate, and similar situation here where stock prices have really run up, and of course we know that launches are still happening and pricing is moving higher. But how should one approach real estate given the run up? And again, if you break it down in terms of developers or geographies, then what would you be more comfortable with? Though, I mean, even as I asked that question, most developers are now going pan-India, getting into each other's territories. But still, what's the approach to real estate?
See, we have to recognize that this is an old economy run. This is focusing on value and the commodity prices. After the US Fed has said that the inflation is not a problem anymore, should do well. Now, when we talk about the interest rate sensitives in the last couple of years have performed very badly, only rising after the US Fed said that there is no problem anymore. Now, I believe that the international interest rate sensitives, I'm just talking about the entire interest rate sensitive theme, should do well. Metals primarily should be the winners of the pack. Now, when it comes to domestic interest rate sensitives like real estate and autos, we believe real estate should do particularly well because real estate can pass on the increase in commodity prices to their customers pretty well. And what real estate can pass that is the luxury real estate. So luxury real estate part for us should do primarily well, and that we are seeing all over India. You can see DLF launching a project starting at 7 crores in Gurgaon, being sold out within a day. Similar, it is happening for other quality developers. I believe that the trend should continue. When it comes to autos, I believe that they will not be able to pass on the increase in commodity prices from here, and they are at an expensive valuation. So I've tried to answer all the three in one question.
Okay, so not that bullish on auto anymore. Anirudh, a lot of investors have been betting on Nifty ETFs. But your view is that the Nifty is not capturing India as it is today. The Nifty constituents represent India's old economy, while it's the new economy stocks which are thriving right now, and that's not captured in the index. So what would your advice be for someone who wants to buy a Nifty ETF or has been investing in it? Because according to you, it has limited significance now, the Nifty constituents.
Okay, so let me just rephrase that a bit. Maybe when I sent you my thing. So what I believe is that the last run, which started from 2010 to 2020, had a major effect on the Nifty constituents. We saw a lot of new economy come in. So if you see Nifty, 33%, around 30 to 35% of the Nifty is private sector banks, and the rest 30 to 35% is new economy in terms of IT, pharmaceuticals, and stuff. So Nifty is today majorly denoted by very quality companies like Dow Jones is. So 66%, two-thirds of the Nifty is new economy quality companies, while only one-third or less than one-third is left for the old economy and the value-oriented sectors. This is an old economy run. We can see all capex, interest rate sensitives, metals, real estate, all these sectors doing pretty well. And I believe that the trend should continue. The only, the only hope and the only support that I find in Nifty is to provide the balance to your portfolio in an expensive market. Otherwise, Nifty is totally an FII's game right now. They are the ones holding it, while the DIs are holding the old economy and generating alpha for their clients. So yes, Nifty today is representing new economy more rather than old economy, which is leading the run right now.
Where do you stand on banks? In the last 4 years, banks have underperformed the Nifty, barring, I think, 1 year in 2022, when it significantly outperformed the index. But other than that, banks have been underperforming the Nifty, despite the fact that now perhaps valuations are looking attractive. And there was this argument made, right, that if India has to grow, if the Indian economy has to thrive, then banks will do well. It's a safe bet. But it's not that banks have performed very well. So considering that it's such a large constituent of our markets in the index, where do you stand on banks?
See, markets, we believe they totally believe in relativity. Banks are the best bets for India, yes. But are their valuations supporting that bet? I believe no. Private sector banks, which are very good lenders in India, were given a valuation that was nowhere in the world. 2 years before, I remember Kotak and HDFC Bank at valuations that were not seen anywhere with the financial companies in the world. See, a stock at 6 price to book. What else do you expect, which has led the run for the last 10 years? I do not expect it to run for another 10 years. We have to segregate banks. The banks which were considered not worthy to invest in, the public sector banks, they had maximum relative change behind them. You saw the NCLT laws come in, you saw government, capitalizing them, and the sectors that they lend to primarily, like metals, real estate, etc., doing pretty well. Old economy sectors doing pretty well. So the relativity uh, made sure that the money would flow to public sector banks rather than private sector banks. And the public sector banks did well from there. If you look at the last 2 years, public sector banks have done better than the Nifty and much better than the private sector banks. So I believe here also the trend should continue. There is still a lot of scope for us according to the relative change in the public sector banks.
Anirudh, great conversation. Thank you very much for joining in. Look forward to chatting with you more frequently. Get into a break. We'll come back and discuss commodities. Manisha Gupta joins in as always.